Ever wondered how a bank, one that had been around for 233 years, survived everything from the Napoleonic Wars to two world wars?
Yeah,
How could it suddenly just collapse in a single year?
yeah.
It sounds like something from a financial thriller movie, but it's actually a very real and potent lesson in something called internal controls.
Mm.
How organizations protect themselves, or sometimes tragically fail to, from fraud, error, and, well, financial meltdown.
Indeed, it's a really compelling place to start. That collapse of Barings Bank back in 1995, due to unauthorized trading, it remains just a stark, almost unbelievable case study.
Right.
And for this deep dive, we've pulled from some foundational stuff. Corporate governance reports, like the UK's Cadbury and Turnbull reports, they really shaped a lot of modern thinking on this.
Okay.
Plus the comprehensive COSO framework and several other illuminating case studies.
So what's the goal here?
Well, our mission really is to equip you with a solid understanding of these systems. We want to move beyond just dry regulations, and see them as critical living safeguards that underpin, well, everything. From reliable financial reporting right through to preventing those rogue traders we hear about.
Okay, let's unpack this then. We're not just going to list rules. We're going to explore what makes these systems genuinely effective, why they sometimes just spectacularly unravel,
Mm-hmm.
and what role everyone plays, from the CEO right down to every single employee in keeping an organization sound and, frankly, trustworthy.
Sounds good.
Let's jump right in. When we talk about controls, I think it often makes sense to start with what happens when they aren't there, or when they fail, often dramatically.
Yeah, the failures are instructive.
That Barings Bank story isn't just some historical footnote, is it? It's practically a blueprint for how internal control breakdowns can just cascade into absolute disaster.
It really is.
So the bank went down in 1995, brought low by its head derivatives trader in Singapore, Nick Leeson. He was supposed to be doing arbitrage on Nikkei 225 futures contracts,
Right, low risk stuff.
essentially making small, low-risk profits from tiny price differences between the Osaka and Singapore exchanges. But what was the really astonishing detail in Leeson's setup that allowed this to spiral so catastrophically?
Well, what's genuinely fascinating and ultimately fatal for the bank was the severe structural flaw in the management oversight.
How so?
Leeson held a dual role. He was both the floor manager for trading and he was the head of settlement operations.
Wow, okay. That sounds
Problematic.
hugely problematic. This astonishing lack of segregation of duties basically meant he operated with virtually no independent supervision from London. None.
So he could hide things.
Exactly. When initial losses started mounting, which, by the way, he initially blamed on a colleague's mistake, he used a hidden account, the infamous 5/8 account.
Ah, the secret account.
Basically, yeah, a secret off-book account used to mask those losses and let him continue his increasingly speculative, desperate trades.
And the losses just grew.
Exponentially.
Yeah.
By February 1995, his activities had generated just staggering losses, 827 million. 827 million.
Yeah, more than double the bank's entire available trading capital. It led directly to its acquisition by ING for, well, a symbolic £1.
It just beggars belief when you hear figures like that. And Barings, sadly, wasn't totally isolated, was it?
No, unfortunately not.
We saw parallels, didn't we, in the Societe Generale case. That was 2008. Their trader, Jerome Carrefour, caused losses of $4.9 billion.
Even bigger numbers.
Right. The bank painted him as this lone rogue trader, but Carrefour himself claimed that these high-risk, unchecked practices were actually widespread
Mm-hmm.
and basically ignored by management as long as the profits kept rolling in.
Which is a common theme, sadly.
So these examples, they don't just highlight individual failures, do they? They point to something deeper.
Absolutely. They show that internal controls aren't just about ticking boxes on some compliance checklist. They're fundamentally about people, about the culture, about the very DNA of an organization.
Right. So that leads to the question, what are these controls supposed to do? What are they actually designed to achieve?
Well, beyond simply preventing those headline-grabbing frauds and errors, our sources like the Auditing Practices Board, the APB in the UK, and the COSO framework, they outline broader, more strategic objectives.
Okay.
They aim to ensure the orderly and efficient conduct of business, safeguard assets from misuse, provide accurate and complete accounting records,
All sounds pretty vital.
and facilitate the timely preparation of reliable financial information. Crucially, though, in essence, they provide reasonable assurance. That's a key distinction.
Not absolute.
Not absolute certainty, no. That a company will achieve its business objectives and comply with laws. There's always going to be an element of human fallibility or collusion or unforeseen events.
So connecting this back to us, what does it mean? It means these aren't just some arcane corporate rules that only accountants need to worry about, right?
Exactly.
They are like the invisible architecture that keeps organizations stable, transparent, trustworthy. And that impacts everyone, from big investors down to individual employees, just wanting to know the lights will stay on and their paychecks will arrive.
Well put. It affects us all.
Thankfully, there are established frameworks designed to significantly reduce the risk of these kinds of catastrophic failures.
Yes, thankfully.
The Committee and Sponsoring Organizations, COSO, developed a really highly regarded framework for internal control. It identifies 5 main interconnected elements, kind of the pillars of organizational integrity.
That's a good way to put it. Pillars.
But for an audience that might be somewhat familiar with these, what's often the single biggest misconception, or maybe the biggest challenge, organizations face in truly implementing these pillars effectively?
That's a great question. Because, while the framework itself is sound, the implementation, that's where things often stumble.
Right.
I think the biggest challenge isn't just understanding the elements on paper, but truly embedding them deep into the organizational culture, not just treating them as separate, siloed checks.
Making it part of the DNA, like you said.
Precisely. Let's quickly run through them, keeping that cultural aspect in mind. First, the control environment. This is famously known as the tone at the top.
Heard that phrase a lot.
Yeah, it's all about the ethical values and the culture set by senior management and the board. Their philosophy, their operating style, how authority is delegated, staff development, their overall commitment to integrity.
So it's not just words.
Absolutely not. If leadership doesn't genuinely value and demonstrate integrity, no system underneath it will truly succeed. That's often the misconception. It's not just a policy statement, it has to be a lived reality.
Okay, element 1. What's next?
Second, risk assessment. Before you can control anything, you absolutely must know what you're controlling against. Seems obvious, but
maybe not always done well.
exactly. This involves clearly setting business objectives, then identifying all the associated key risks, both internal, like operational failures, and external, like market shifts, controllable risks, uncontrollable ones,
Okay.
and then deciding how to manage or mitigate those risks. It's about being proactive, not just reacting when something goes wrong.
Proactive identification. Got it.
Third, control activities. Now, these are the actual policies and procedures, the things implemented at all levels to make sure management's instructions are actually carried out.
The nitty-gritty.
Yeah, the nuts and bolts. Things like authorizations, verifications, reconciliations, approvals, that crucial segregation of duties we mentioned, performance reviews, asset security measures. These are the detailed, on-the-ground checks.
Okay, that makes sense. 4th element.
Fourth is information and communication. An organization has to gather and communicate relevant, quality information to the right people at the right time so they can do their jobs, fulfill their responsibilities.
Information flow.
Exactly. Effective information systems are absolutely key here, both for informed internal decision-making and for accurate external reporting. Without good information, decisions are basically made in the dark.
Right. And the last one.
And fifth, monitoring activities. This isn't a one-time setup, you see. It's about regularly reviewing the effectiveness of the entire internal control system.
An ongoing process.
Continuous. Management, often helped by audit committees and internal auditors, identifies any deficiencies, assesses their impact, and reports them up the chain to senior leadership and the board. It's a constant feedback loop.
That really clarifies it. So it's definitely not a static structure. It's a dynamic, continuous process.
Okay, let's zoom in a bit on those control activities because, as you said, this is where the rubber meets the road. They're the practical safeguards. And if we had to pick one cornerstone activity, segregation of duties comes up again and again. Why is it considered so fundamental? What makes it powerful, but also, you mentioned, vulnerable?
You're right. Segregation of duties is absolutely a cornerstone. It's powerful because it very strategically breaks down a transaction into 3 distinct responsibilities.
Okay, what are they?
The authorization or initiation of the transaction, the actual handling of the asset involved like cash or inventory, and then the recording of that transaction in the accounts.
So different people doing different steps. Precisely. Think of it this way. The same individual shouldn't be able to initiate a purchase, then make the payment for it, and then record that same purchase in the financial records.
Makes sense.
By dividing these tasks among different people, you significantly reduce the risk of both fraud and just simple human error. because ideally it requires collusion for malfeasance to occur.
But that's its weakness.
That's its Achilles heel, exactly. A critical limitation is precisely that it's not effective against collusion where two or more individuals deliberately conspire to commit fraud. They can override the separation.
That's a really crucial distinction. People often overlook that, don't they? A sound control on paper can still be bypassed by coordinated human intent.
Absolutely.
And beyond segregation, our sources highlight other practical controls. Things like physical controls, safes, secure entry systems, maybe dual custody for valuable assets.
Yep, locks and keys, essentially.
Authorization and approval controls, like spending limits, supervision of work, and personnel controls, making sure you hire suitable staff and train them properly.
All important parts of the mix.
These are the detailed mechanics. Yet, even with all these mechanisms seemingly in place, failures still happen. What, beyond just collusion, are some of the most common reasons these systems break down in practice?
Well, it's often a blend of human factors and sometimes systemic weaknesses. The Turnbull report, for instance, it highlights several common culprits.
Such as?
Things like poor judgment by individuals, simple human error, someone just messes up, deliberate circumvention by employees, maybe for a perceived personal gain like hitting bonus targets.
Right.
And critically, management overriding controls managers believing that the rules don't quite apply to them, perhaps for expediency.
The rules are for thee, not for me syndrome.
Sort of, yeah. And sometimes you just have unforeseeable circumstances that nobody planned for. A black swan event, if you like.
Okay.
And this actually brings us to a really compelling real-world scenario from our sources. A serious fraud uncovered at a large college. It perfectly illustrates these limitations.
Okay, this sounds interesting. Let's delve into this college case.
Right. So in this scenario, a clerk in the payroll department, let's call her M, colluded with a head of department. We'll call him P.
Dope. M and P.
Their goal was to create a fictitious part-time lecturer on the payroll.
A ghost employee.
Essentially, yes. Now, M gained access to the personnel supervisor's office. How? By guessing the password.
Oh, no. Please don't say it was password 123.
Worse, it was, shockingly, the supervisor's car registration number.
Oh, dear. Okay. Not good security.
Not good at all. So M gets in, adds the fake employee into the system. Then P would regularly submit fraudulent claim forms for work that was never performed by this phantom lecturer.
And this went on for
a staggering 3 years, resulting in steady payments just funneling into P's bank account, which of course was shared with M.
3 years. How was it finally discovered?
Almost accidentally. The college was having a centenary celebration, sent out letters to all staff, including, obviously, the fictitious one.
Oh.
The letter was returned as undeliverable. That tiny anomaly triggered the investigation.
Wow. So what does this case, beyond just the basic description, what does it really tell us about the vulnerabilities, even in seemingly established control systems?
It's just a profound lesson, isn't it, about how human factors can completely undermine even theoretically sound controls.
How so, specifically?
Well, look, segregation of duties was technically in place for adding people to payroll. It required supervisor approval.
Right.
But it was completely defeated by several layers of failure operating together. Firstly, active collusion between two trusted employees.
Okay, broke the segregation.
Secondly, deliberate circumvention of controls, which was only possible because of that ridiculously weak password. Basic security failure. And thirdly, an oversight in what the subsequent government investigation actually called the human resources aspect of the system. Maybe not enough vetting, perhaps.
Okay.
The deeper insight here is that these small, steady frauds involving people who seem trustworthy within large organizations that might have high staff turnover, they are incredibly difficult to detect through just routine checks alone.
They fly under the radar.
Exactly. It highlights that a sound control written down on paper can be utterly breached by determined, coordinated human intent, coupled with simple negligence in critical areas like password security. It really tells us that trust without verification is a very dangerous thing in finance.
That's a powerful point. The human element, both in terms of malicious intent and just basic oversight, seems consistently the weakest link.
It often is.
So if controls are the structural system, then timely and accurate information must be the fuel that keeps that system running effectively.
Undeniably, yes.
Our sources strongly emphasize that management needs adequate, timely, relevant information flows, not just to identify and manage risks, but also to effectively monitor those internal controls we just talked about.
Absolutely. Monitoring relies on good info.
And this isn't a one-size-fits-all situation for information, is it? Different levels need different things.
Precisely. This is crucial because managers operate at, broadly speaking, 3 distinct levels, and each level has fundamentally different information needs and activities.
Okay, break that down for us.
Okay, first, you have strategic managers. Think the board of directors, the CEO. They focus on overall long-term planning, setting the organization's direction.
Big picture stuff.
Exactly. And ensuring the entire internal control system is adequately resourced and effective. They need broad, often forecasted, qualitative, sometimes subjective information, typically from systems like an executive information system or EIS.
So not super detailed.
No, the accuracy might be rounded, information can be partial, but it's essential for those big picture decisions on risk appetite, strategic direction. They're definitely not looking at daily minutia.
Right. Okay, level 2.
Second, tactical managers. Think divisional heads, maybe regional managers. They're responsible for implementing those strategic decisions within their areas and managing the actual control systems at a more granular level than the board. Their information needs are kind of a blend, some forecasts, some historical, largely objective, and quantitative. They often rely on decision support systems, DSS, or management information systems, MIS. They need enough detail to act, but not necessarily overwhelming amounts.
A middle ground. And the third level.
And third, operational managers. These are the people on the front line. Supervisors, team leaders. They're controlling the day-to-day activities and the specific detailed controls like preventing stock theft from a warehouse or managing daily sales transactions.
A real sharp end.
Exactly. They require highly detailed, often immediately available, historical, objective, and very accurate information. Typically, this comes straight from transaction processing systems or TPS.
This difference in information needs seems absolutely critical. The strategic manager, say, trying to decide whether to invest billions in opening a new factory overseas. They really don't need to know every single daily sale figure from a specific branch in, I don't know, the south of England.
No, that would be information overload.
But an operational manager responsible for managing inventory in that very branch needs that granular detail, probably in real time, to prevent stockouts or spot theft.
Precisely. If the information isn't right, meaning accurate, complete, timely, and appropriately targeted for the user, then the entire control system is compromised at that level.
And particularly for the board.
Yes, the board in particular relies heavily on accurate, well-summarized reports to understand systemic weaknesses across the organization and ensure that monitoring activities are genuinely effective, not just, going through the motions. Bad info leads to bad oversight.
Okay. Given how pervasive fraud can be, unfortunately, and how challenging it often is to detect, let's talk specifically about how organizations can strategize against it.
Right. Fraud risk management.
Our sources outline a comprehensive kind of 3-pronged strategy: prevention, detection, and response, all ultimately aimed at deterrence.
That's the framework, yes.
But what's often the hardest part about implementing the detection aspect, especially if, as you mentioned earlier, external auditors aren't primarily responsible for finding fraud. Who is then?
That's a great question, and it really speaks to a common misunderstanding. While external auditors do look for material misstatements in the financial records, which could be caused by fraud, they typically state upfront in their engagement letters that finding every single instance of fraud is not their primary job. Their audit is designed to provide reasonable assurance about the financials overall, not absolute certainty against fraud.
So it's not their main focus.
No. So for detection, the hardest part is often that most frauds aren't actually found by sophisticated algorithm or planned audits, surprisingly.
Really? How are they found then?
Well, often they're discovered almost accidentally. Through internal whistleblowers, someone speaks up. Or through very routine checks like stock takes or bank reconciliations that just happen to flag an anomaly that doesn't make sense. The warning signals are often quite subtle initially. Maybe minor control failures, unusual staff behavior, unexplained variances in the numbers. It requires vigilance internally.
Okay, so let's break down those 3 prongs then, starting with prevention.
Okay. Fraud prevention is all about reducing both the opportunity and the temptation for fraud in the first place.
How do you do that?
It includes things like having robust anti-fraud policies that are well communicated, thorough recruitment processes, background checks, regular fraud awareness training for all staff, not just finance, And critically, as we've discussed at length, having sound internal control systems in place.
Like segregation of duties.
Exactly. Segregation of duties is a classic preventative control, trying to stop it before it starts.
Okay, prevention, then detection.
Right, fraud detection. As we just touched on, this is about finding fraud after it has occurred or while it's in progress.
And it's mainly internal.
It requires active internal monitoring, vigilance for those red flags we mentioned, and importantly, creating an environment where employees feel safe and encouraged to report suspicions. Whistleblower hotlines, things like that. Organizations really need to understand that this is their ongoing responsibility, not something they can solely rely on external parties like auditors to handle.
So internal vigilance is key. What's the third prong?
Third is fraud response. If fraud is suspected or confirmed, an organization absolutely needs a clear, predefined plan for what happens next.
A reaction plan.
Yes. This involves steps like gathering evidence properly, often forensically, taking appropriate internal disciplinary action, potentially pursuing civil litigation to recover funds or even criminal prosecution.
Right.
And it involves coordinating various internal and external parties, from the finance director and the audit committee internally to internal auditors and potentially even law enforcement or public relations consultants if the incident is significant and might hit the news.
And the plan itself is a deterrent.
Exactly. The very existence of a clear, decisive response plan acts as a powerful deterrent. People are less likely to try something if they know the company has a robust process to investigate and prosecute.
So it really is a holistic approach then. It's about building a culture of integrity, setting up robust systemic safeguards, actively looking for problems through vigilant internal processes, and crucially, having that clear, well-rehearsed plan for when problems inevitably occur.
Precisely. No single step is a magic bullet on its own. It's the synergy between prevention, detection, and response that makes the strategy effective.
Okay. Today, we've definitely gone beyond just the jargon, I think, to explore the profound importance and the intricate workings of internal control systems.
I hope so.
From trying to prevent the next Barings Bank-type disaster to safeguarding against that silent creep of something like the college fraud we discussed.
Yeah.
These systems really are the unsung heroes of organizational integrity, aren't they? Providing a framework for stability in what's often a complex world.
I think that's right. We've clearly seen that sound internal controls, they're deeply embedded within good corporate governance. They rely heavily on tailored, timely information flows, as we discussed. And at their heart, they are the collective responsibility of everyone in the organization. From the CEO setting that ethical tone at the top.
Right down to?
Right down to every single employee acting with vigilance and integrity in their daily work. They offer reasonable assurance, yes, but as we've stressed, they are not foolproof. They're constantly battling human error, deliberate circumvention, and those unexpected, unforeseen events.
So think about what this deep dive means for you listening in. Whether you're navigating a large corporation, maybe managing a small business, or even just organizing your own personal projects. Understanding these principles is really invaluable.
It really is applicable everywhere.
It's about being proactive in building safeguards, being shrewd about identifying your risks, and recognizing the critical, undeniable role of accurate information and unwavering integrity.
Well said. And as you reflect on all this, maybe consider this provocative thought to leave you with. Given the inherent limitations we've discussed, for any system, human error, the potential for deliberate circumvention, the risk of management just overriding controls. Can any internal control system ever truly be foolproof against determined human intent? Or is the ultimate control always rooted in something perhaps far more fundamental than procedures and policies? Something about shared values, culture, accountability, something that transcends the written rules.
That is something to ponder. Can culture ultimately trump controls?